Part of the market backdrop as we go into the jobs report is a real pullback in 10-year yields, Mimi, and even in the past week, it's been a dramatic change. We were just talking about fixed income volatility, and that has allowed a lot of the growthier areas in the market to go higher. And you think biotech is one area that has gotten really cheap. I mean, certainly the yield backdrop, the improvement in terms of going lower has helped that trade. But what do you like, longer term about biotech?
Yeah, so biotech is one of those sectors that has just been extraordinarily beaten up. And to your point, we seem to have, at least for now, carved out more of a range. It's a big range, 280 to 350 in tens. But I think that stability will give some of the growthier sectors of the market that have been beaten up so much, like biotech, 20% of the names there have more cash on their balance sheet than their market val. So those are opportunities that we like. And to the extent that we see a bit more stability in the rate complex, which I think will come with just more data. And as we learn more about how this evolution of the economy is proceeding with, we're now into, say, 6 months of rate hikes. If we factor in that the Fed uses communication as a tool as well, they started communicating toward tighter policy very early this year. So as we go through this process and get more information, then we should see more stability in the rates complex as well.
Kevin, we have never seen an emergence of a modern society from a pandemic before. We've seen it, but it's been 100 years. So maybe we're not supposed to understand the way everything happens and the cross currents and in things that are going on. I was reading, it says here that memory prices are down so much. They're plummeting. They're weakening. It's because we're out of the pandemic. So maybe what do we need? Like a nuclear oblivion to really get the chips going next time when we're really staying home? It's just odd. It's odd that so many sectors of the economy did so well during the pandemic. And now we're using it as an excuse for companies not doing as well. No one would have predicted that.
No, I mean, you bring up a great point. If you get a once in 100-year pandemic, things change, the landscape changes a little bit. And I'll pivot to the conversation that Mimi was talking about a little bit earlier with respect to a recession. I think we're in a recession, Joe. We saw the GDP revised a little bit lower last week for Q1. If Q2 comes in at flat, zero, or down slightly, that gives us 6 months of decelerating GDP. And I know that there's new definitions, and the NBER has all kinds of things that talk about labor, employment, and other factors. But old school guys like us, 6 months of decelerating economic growth is a recession. Anything else is just a matter of semantics thereafter. So I think to your point, coming out of a pandemic, you've got to look at things through a little bit different lens. Is inflation peaking? Yeah, maybe. We've been saying it off and on for so long, and the broken clock theory means at some point we're going to be right. But the PCE data last week gave us a little hope. We'll get CPI next week. I mean, it's got to level off before it goes down. And to your point, everything's going to be different in these markets that cause corrections. The 2008, 2020, what we're seeing now in these pullbacks. Bottom line is you just got to look at valuations, stick to quality, and not start chasing companies that are unprofitable and have declining revenues. And I'm fearful that people might start looking to trade again. We're still in a bear market. You have rallies along the way. But I think the message today is investors just need to still be very careful.